We turned around and built the strongest nation on the planet out of that dust. In 1879, after the crash of 1873, when the railroad stocks crashed and the government stopped redeeming money for silver, actually paying out silver, specie it was then called, S-P-E-C-I-E, we had a big crash and we had a lot of reconstruction debt, and 6 southern states defaulted on their bonds issued by the general obligation bonds. Georgia, by act of the legislature signed by the government, defaulted on its entire $9 million general obligation bond issue in 1879. The comptroller of New York was ordered by the New York legislature, do not buy bonds issued by Georgia. Do you know who bailed out the bondholders of Georgia bonds? Nobody. Nobody bailed them out. And as a result, the system got stronger. In 1966, almost every bank in Japan went belly up. They turned around and built the strongest manufacturing powerhouse on the planet. So what happens when you bail out auto companies, banks, insurance companies, as we did in 08 and 09? It's tough. It creates tough times. But when you bail them out, what happens is you take money from competent people who work in New Jersey and live in the Philadelphia area, from competent people who live on an island off the coast of South Carolina, from competent people who have recently moved from Ireland to the States, and you give it to incompetent bankers, auto executives, and insurance companies. As a result, the system gets weaker. You take money from the strong to fund the weak. You make the strong weaker. You make the weak be dependent on it. The aggregate society gets weaker. So after the Georgia bondholders in 1879 lost their entire investment, after that, they asked better questions. When they went to buy a bond from a state, they said, okay, tell me about your financial situation. Tell me about you, tell me you. And they made the bankers sharper, made the state government sharper. Collectively, the system gets stronger when the weak are allowed to fail. In the consciousness of the United States, nobody fails. This began with the self-esteem movement in the schools. You got a gold star if you just show up. And there are reasons why that evolved, which I won't go into, and I have opinions about it, why that didn't occur on its own. And so this idea of nobody fails. Oh, we can't let these people fail. We can't let these people fail. But the collective bailouts by the federal government have gotten to be such a magnitude that, in my opinion, unless something drastic is done, and there's no hint of either of those two things happening, the federal government itself is going to have major problems, and life will be very difficult. In a sense, the structures that support society to some degree are going to come apart. Even The Economist this July said America's lost oomph. They talked about what could be done. Spend money on infrastructure. We have really rotten infrastructure in many ways. Improve education, reduce regulation, fix the corporate tax structure where we have the highest nominal tax rate in the world. We're not competitive in that regard. So there are some things that could be done, but there's no hint of them happening. So here we have this trend right here. What are the two things? So it's only the second time in U.S. history where the debt has exceeded the GDP. Now, what are the two things that could happen to fix this? Maybe one of you has a third. I hope. I hope maybe there's something I don't see. One would be to fix the deficit through some combination of tax increases and or spending cuts, wipe out the deficit. If this were to happen, and there's no hint that it will in my view, it would cause a deep economic downturn because you would take $500 billion out of GDP, and that's 3 4%, whatever it is, at a $17 trillion GDP. That would cause a deep economic downturn. This is a society, in my perception of it, that doesn't want to take a hard right course of action. Let us just continue on short-term thinking. There's a little incrementalism here, incrementalism there. That's one thing. I see no hint of that happening. I'm always watching. Maybe something changes. The other thing that could change this would be rapid economic growth if we repeated what we did after WW2. And so let's look at the chance of that. And we'll turn the page. And we see here, this is real GDP. And these are simple, you get this from the BEA, none of these are my numbers, from the BEA website, and so the lines wouldn't be so jiggly and dancing around so much. I simply struck an average of the annual real GDP growth, and the first is 1950 to 1954. I wanted to get it kind of materially after the war, and we see here that the average real annual GDP rate that 5-year period, and I intentionally picked 5 years so it wouldn't be the 4-year kind of political coincidence. It doesn't coincide with anybody's election cycle, was 5% per year. And this is a simple linear regression line, and we have this data point here, which is 2010 to 2014, almost finished, and it's here, but the long-term trend of the growth in GDP is down. Now, GDP is still growing. This is the growth rate. So it is growing. This is still positive, thankfully, but it's growing at a less rapid rate. And my reasons, the reasons I attributed this to, are given in the lower left there. Aged infrastructure, spreading regulation, so forth. The real estate crunch that we had, and we have not worked our way out of. As Mr. McCavity pointed out, or McAvity, how do you pronounce it? One or the other. He's sitting in the back. So he pointed out that the housing recovery brought us up here, but we were way up here. So the real estate crunch had a big impact. So what is the prospect? Do we see growth policies by the federal government, either fiscal policies or monetary policies, that will change this? I personally do not see them. If I were emperor, I would repeal Sarbanes-Oxley, which has made going public much more difficult and caused a lot of companies to leave the country, to list elsewhere. It's not because the tax inversions, which get a lot of headlines, there's no material money there. Another would be the Dodd-Frank legislation, which is red tape and so forth, yet to be written. Other legislation. So we have spreading regulation. So you could repeal some of those things. You could cut the individual tax rate. You could cut or eliminate the corporate tax rate. Corporate taxes only generate about 10 or 12% of total tax revenues in the United States. So something to stimulate growth. I personally don't see it happening. And that is in fact, what I see happening, if my view about the future of stocks, and as we know, the stock market is even part of the leading indicators, LEI, the leading economic indicators, that when stocks go down, which surely they will given our forecast, when stocks fall materially, and I'm not bearish on terms of a 10 or 20% decline, that's nothing, it's unforecastable. Should that happen, GDP will turn negative, we'll enter a deep recession. So both the economy will go down and the debt will go up at a more rapid rate. So the lines that you see here on this second chart will diverge even more rapidly, with the debt being even far more above GDP. So those are the way out of it, 2 ways out of it. I have 3 other charts on the back here. So one of them shows, and there are many things that I look at. This is certainly not the entirety of it. This is one of my own little momentum measures. It shows the S&P. We have 3 big stock market indicators in my view. One is momentum, which we see here, at least one of my stripes. Another is valuation, which, as Mr. Schiller says, valuation is a measure of risk. It's not a timing measure. To me, risk is stratospheric in stocks. And the third is sentiment. But sentiment invariably follows the other two. You know, it's not really a separate measure. And then we see gold, which is a phenomenally wonderful opportunity to buy. And silver is just way down. Silver's down from its record high of $50, and it hit $49 in April of 11. It's down to 16 or 17 today, whatever it is. So one closing point, and then we'll have time for a few comments or questions. Closing point is that what will be, should this bearish view of stocks and of the economy materialize, which half of us see things that way and the other half are pretty bullish. Well, I hope the bulls are right, you know. But should it materialize, what will be the government response? They will do two things, given that we don't want to take the hard action. One will be to spend money. We'll have even more stimulative fiscal policy. The other will be that the taper will go away and we will resume money printing. Those two things, in my view, are pretty much baked into the cake, are what is coming. So, as we've discussed, the supply of gold is this cube, at about the length of this room cubed. So now we're going to have the unit of measure in which we express this thing going way up. And so the inventory of gold not going up very much. So every currency in world history has gone to zero against gold. Every one of them. Gold has never gone to zero. Now here's a store. The store is in Virgins. There's a storefront. They say, hey, come get all the free gold you want. You have to pay us for our salary and our rent and transportation and store, you know, and for have lunch. But here is gold. Come get free gold. Can you imagine that? I cannot imagine it. You know how many times it has happened in economic history? Zero. In fact, the converse has happened in every case. We're selling currency. We're selling big bundles of Zimbabwean currency. Come get your Zimbabwe currency. You have to pay us for the shipping and for your salary and the rent and so forth. You want a big bundle of Zimbabwean notes, whatever their currency is called these days? Well, come get it. That's been the case. So for me to believe that gold will not ultimately exceed $10,000, I would have to believe there's going to be something, or already is, something exemplary and meritorious about this currency that would make it the first one in economic history where the currency did not go to zero versus gold. This currency is already on the way to zero. What we call a working person today makes $80 a day, $90. That's a rough estimate maybe, with the minimum wage soon going to $10.10 an hour. In the 1890s, that same person made $1 a day. It's a typical pay. Henry Ford made national news, shocked the country, when in the teens he paid his assembly line workers the staggering, unheard of sum that was going to bankrupt him, $5 a day. He said, you can't pay that much? He said, I want my workers to be able to afford my product. $5 a day. When I was a kid, just yesterday really, it seemed like, there were 5 and dime stores. And you could buy a lot of things in there for a nickel. Today, we don't have those anymore. We have dollar stores. And there are a lot of things in there that cost more than $1. Up until 1934, for several decades, the price of gold had been fixed by the government at $20.67 an ounce. In the early days of 34, because the federal government was running out of gold, at the stroke of a pen, the Congress passed the Gold Something Act, and FDR signed it, and FDR personally pulled the number of $35 an ounce out of the air, and they said, we're now going to make it $35 from $20.67. Anyone who owned gold did pretty well on that day. Had a big gain of 2/3 or whatever the number is. And it's an interesting thing, in the months leading up to that period, in the latter part of 33, FDR and his group, the Secretary of State, Morgenthau, the Treasurer, and so forth, met daily in the White House, and they set the price of gold at which the government personally did it. And one day that crowd, Morgenthau wrote later, walked into FDR's office, and FDR had a big smile and his cigarette with a cigarette holder, and he said, I'm feeling really good today. He said, well, the price of gold today is going to be $34.77 or something, whatever the number was, but it ended in 7. And he said, why? Why 7? And FDR said, well, because that's one of my favorite numbers, 7. That went on for several months, where this group personally just pulled numbers out of the air to price gold. So gold went from $20.67 up to $35, and it remained there till it was floated by Nixon in August 15th of 71, because again, we're running out of gold. It then ran in 9 years from $35 up to $850 in January of 1980. And this will be the last thing I say, because I want to finish, even though we got started a little late. I think I can finish this in just a few minutes. We'll get it finished early. So gold went from 35 in 9 years up to $850. This was a period of bad economics, tough times in the late 70s, inflation, high interest rates. Some people you find here today say, oh, high interest rates are bad for the price of gold. Well, we only have a sample size of 3 economic periods in the movement of gold since it was floated. It's not much of a sample size. You know, I used to teach statistics to MBA and PhD students. So, I mean, even I would say sample size of 3 is pretty small. But in 9 years, gold multiplied itself by a factor of 24 times. Not 24% a year. It multiplied itself by a factor of 24 times. And if it had just been a catch-up period, pent-up demand because it had been frozen, then it would have leapt right away. It took off kind of slowly and went up. Then what happened, starting in 1980, we had a big economic boom. The top in gold in January of 80 preceded the boom. As Mr. Zimmerman knows, in September of 1981, the 10-year Treasury was a little over 15%. And the stock market took off in August of 82. And both of these began a period of huge prosperity. The price of gold began to fall a year earlier, and it went down for a long, shallow bottom from 1999 to 2000 to 01, and went to $254 an ounce is the number I have in my head. So it fell for 19 to 20 years while the economy went way up. Now we've had, since 2000-ish, a rough economy. We've had the second and third deepest stock bear markets in U.S. history, and getting ready to enter the third, in my opinion. And I very much appreciate the notion that, well, we have a breakout, so all is well. Well, sometimes you have what are called false breakouts. So what has happened in this period is that gold has again gone up, and now it's falling lately. But even today, if we look at this century, and you know there's always an arbitrary aspect, there's the arbitrary starting point of 2000. Well, total over the whole period, from the beginning of the year 2000 till today, the S&P 500 is up about 35% total, not per year. That's the amount it's gone up in 14 3/4 years. The price of gold in the same period has multiplied itself by a factor of 5. 5 times. That's a little more than going up 35% total over the period. The point is that gold tends to move in the opposite direction of the broad economy. So the thing that would make me bearish on gold is if I thought the economy were going to take off, going to have some kind of big economic boom. But even then, I've only got my sample size of 3, then I've got money printing, and I've got big debt. Even if we had no money printing, high debt has always caused currencies to have problems. And when the currency goes down, by definition, the price of gold and silver and so forth go up. So I'm very bullish on agriculture, even though this is so much a deflationary period for now. And I'm bullish on gold and silver long term. I don't have that much of them, but should they really get slammed, I will add more to both of them. Thank you very much for your attention. Any questions, comments?
When you say you're bullish on agriculture, would you define that a little bit?
Yeah, the things itself, the stuff, not the companies that Monsanto and so forth, whatever they are. I never buy individual stocks. There's nothing wrong with it. It's just not my very specific strategy I adhere to. So even though corn, wheat, the beans and so forth are just getting slammed these days, long term I'm very bullish on them. So the one that I own in particular is DBA. It's an ETF that owns 9 agricultural commodities. And to buy it these days when it's down, most likely is a very fine thing. Yes, sir?
You buy farmland? I mean, talking about agriculture.
I think farmland is probably one of the smartest things to own. You know, one of my heroes, Jim Rogers, who moved to Singapore 9 years ago, the biggest single reason he moved to Singapore, in my view, is he saw what's happening with the debt. He could see the American mentality. That's the reason Jim Rogers left, in my view. And he's also very bullish on farmland. My sense, even though it's down these days some, although I'm no expert. Somebody here is an expert in it. Who is it? Somebody knows a lot about farmland. But yeah.
How would you buy it?
Just buy, well, you wouldn't necessarily have to buy the land itself. You could, and now I'm quoting Rogers because I'm no agricultural expert. He says get a Maserati dealer in the countryside of Kansas, in Kansas City or something, you know, in Des Moines. Get something that would benefit from rising prosperity. We tend to go through periods where the financial types like me do really well, although I plan to make money in what I see as a major bust coming. And then we go through periods where the people who produce real stuff do well. So the odds are, after the current deflationary period ends, then the stuff does really well. So it wouldn't have to be farmland itself. It could be anything that would benefit from rising crop prices. See you at dinner.